Why isn't it raining money on you? I mean, you have a great narrative, you have a great business, it's food security, or I don't know how you classify it, but...
One of the things that affects a business like ours that's infrastructure is the macro.
You've seen a lot of crazy things within crazy markets. I'm wondering how you're viewing this.
Well, I'm thinking that this GameStop situation is the craziest I think I've ever seen.
The world was flush with cash at 0% interest rates seeking homes, and it was a lot of excitement about ag tech broadly. People are announcing, no, we're going to use AI, and the Moore's law of LEDs is going to drive this, and it's going to be the panacea to food. We'll produce anything, anywhere. We're the Tesla of vertical farming, right? And everyone was throwing money at it. InFarm in Germany raised close to $1 billion. AppHarvest, $2.7 billion valuation in American and de-SPAC. AeroFarms raised hundreds and hundreds of millions. Plenty has raised $900+ million. Both of those companies are now bankrupt, by the way. AeroFarms and AppHarvest, right? They're both gone.
But the other failed because they were bad actors or because the unit economics didn't work?
Well, I'd say bad actors. I mean, they were, it's a combination.
Were they selling a wrong narrative?
Snake oil. It's snake oil, yeah. I mean, for example...
Hi everyone, and welcome to Conversations with Loulou. I am Loulou, a venture capital investor, an entrepreneur, a mother, and your host. My guest is Sky Kurtz. He is the co-founder and CEO of Pure Harvest Smart Farms. I'm sure you've seen their products across supermarkets here. They have amazing tomatoes, strawberries, leafy greens, and sauces as well. Most recently, Sky is leading an agri-tech revolution right here in some of the world's harshest climate, here in the desert of the UAE and Saudi Arabia. This episode is extremely exciting for me because it touches on two key themes. The first one being entrepreneur-investor relationships. Sky was an investor before he ventured into becoming an entrepreneur, and he offers extremely pragmatic advice that I really recommend every entrepreneur should hear. And also, it's a masterclass on how you build an agri-tech business, especially here in the MENA region, and some of the challenges. It's a behind-the-scenes look on some of the challenges that he has faced growing this business since 2017. Sky and I were in deep conversation as soon as he walked into the studio, so I didn't want to cut out this conversation, so we're just going to jump right into it. I want to wish you happy holidays and enjoy this amazing episode. I had Chris Rogers last time on the podcast, and we were just talking. He was saying not all startups that get started actually deserve funding or have the economics. You know what I mean? To get a Series A, B, and C, etc. So he made a good point. Like maybe you need sort of to look at the quality of these companies and then figure out what the actual gap is.
But I would still say they call that the graduation rate, right? How many seeds become A's, how many A's become B's, and there's a cohort. Yeah. And unfortunately, the graduation rates are very, very low. So it's a sign of, again, it's a chicken and egg problem. Our region is less mature, therefore less mature founders beginning. In, for example, Silicon Valley, almost all founders are somebody who either went to a great school that practically breeds founders, Stanford, or they've worked in another company that scaled a bit and then they're starting. So they have that rung of experience.
Yeah.
Here, there's so fewer of them, right? Because we're a younger ecosystem. So the quality of the companies and the quality of the founders is lower, right? The challenge is that then begets a lower graduation rate and a lower eventual success rate. We do have many now reasonably mature, like B to E stage companies, but that need to find buyers and or public exits, et cetera, right? And strategic exits, as we know in the region, there are many large family-owned conglomerates that are a huge portion of the wealth and GDP that often don't buy companies, right? They don't have the thesis, the capabilities internally, and the desire to purchase companies at meaningful capitalizations. And not to say none, but it's lesser than you would see in, for example, international conglomerates that often M&A is one of the inorganic growth is one of the ways they grow their businesses. Yeah. And that's a bit of a change in culture, change in experience, and they have to have good experiences where they buy a company and do very well with the acquisition. But again, it takes time. As a result, it just limits the number of buyers that exist in the market for successful companies here. You can't have companies need to have been so mature to be able to list or it could be 10, 13, 15 years out, right?
Yeah.
That companies achieve this.
Yeah.
Amazon wasn't net income profitable for 11 years. So are they going to wait to year 12 or 13 to be able to list and access the public markets? It's a very long time.
Yeah.
That's very long. Like most funds don't exist that long.
Yeah.
Like a venture capital fund has like a 10-year and often less mandate. So that's challenging.
Yeah. And you don't have necessarily, I mean, you do have deep pools of capital, right? That can theoretically keep funding those companies before they exit, like through an IPO.
Interestingly not, though, right? I mean, the private equity market in this region has been decimated, right? Post-Abraj, name how many $1 to $5 billion funds exist.
Yeah,
It's
not
like
many.
you could under two hands.
Yeah.
Right? That's a challenge. Are they going to own every company in this region? Right? So no, I actually think that there's a lot of seed and A stage. There's been a huge proliferation of investment activity and funds, particularly for tech. Not if it's capital intensive. Let's set that aside. But then kind of in the B to E stage, it's a thin universe. In certain sectors, there's significant activity. For example, fintech's been hot, and it happens to be a very capital efficient business model. It's software. So then, yes, check. That sector can access capital. But there are so many areas that will struggle because there's just not many funds that have the pool, the stage of investment, and the mandate specifically for many of the business models that exist if it isn't software.
What
right?
about the PIF, Mubadala, like these guys?
They're being active, or at least more active, but I would say surprisingly not. I mean, how many companies do you know that are funded by them? But it's not a huge number. And so it's important. They have become a funding source. But I think that we need that sort of 1 to 5 billion funds with growth equity and kind of late stage crossover mandates. And there aren't many. I know that because we're in that world now, right?
Yeah.
I'm actively capital raising, having talked to, I'm as well connected and aware of the market as anyone. And there aren't many, right, in the region. And then if you go abroad, how many funds actually have the mandate in the region, GCC, et cetera, et cetera. In my specific sector, it's even more challenging because it's asset intensive agriculture, right? Relatively first of its kind business in the region. And then you add to that domestically, agribusiness is a protected sector, as it is in many places in the world. Oil and gas is quite a protected sector. You don't see foreigners investing actively in oil and gas. But here, that adds an added layer of challenge. But I would say even for other companies, there are many, like when you go down the list of international funds that have a GCC mandate, it's not a big list.
Yeah.
However, a green shoot is it's changing. People want a presence in this market. Over the last 2 years, you've heard a number of funds naming building an office here. Folks like TA, General Atlantic, Apollo, et cetera. Yeah. That's literally the last 2 years. Right, it's been a very recent thing. Now, the benefit is the GCC has had
and they have funds, I think, from the region, which they are mandated to invest in the region as well.
Yeah, like BlackRock does.
Yeah.
I would say many of the others don't yet, though I think that's coming. I think also they're showing their commitment to the region and to the vision and needs of the leadership here. You want our LP capital to invest all over the world, you're going to invest some of it here and develop our economy, which I think is great.
It's great.
If I were the leadership, I would have required that 15 years ago. Right? I think it's fantastic. Yeah. But that said, I think it's good for the ecosystem. Those funds coming also will help. As I understand, for example, using General Atlantic, I think they've invested over $1 billion over the last 3 years in the GCC. Now, some of it concentrated in 1 or 2 transactions that were semi-governmental. However, still meaningful bets happening. Even my old employer, Francisco Partners, invested in Property Finder here. That shocked me. I thought that was fantastic news.
Yeah.
And
why did it shock you?
The GCC wasn't on our radar, right? Not even on our radar.
And why do you think they made that investment?
I think the market's developing. It's a sector. Property is a pretty well-developed sector here, right? From a tech investment perspective, it's playing it safe. It's a software business, a marketplace business, if you will.
Yeah.
Invest in real estate, which couldn't be a more established asset class in the region, in a well-established, mature company. I think it was a fantastic first bet if I were them. Like the right profile of company to kind of put your foot in the water. And on the bright side is now that their foot's in the water, they'll get more familiar with the region. Somebody on that board who's within that investment will now spend more time here for board meetings. That's how you start to build an ecosystem and comfort here so that the next investment proposed from the region, the IC, the investment committee and decision bodies have comfort with it, right? And I think that will be a benefit that we should see that comes out of when we talk about these folks building offices here. If you're seeing Sequoia and TA, Teachers Associates, and General Atlantic and Apollo active here, it becomes a lot easier if you're a young investment professional in one of these funds to advocate that this is a market you should put time and energy into coverage. And in doing so, I think the benefit is it's sort of a buyer's market, as I mentioned, because there's a dearth of funding from B to E stage. So you can kind of come in and name your terms, right? You can come in and people would be honored to have you and to work with Sequoia or whoever it is, right? Those who come early will have disproportionate gains. Now, they, of course, have to do the homework, be quite selective, pick the right companies, good markets, et cetera, but they will probably be rewarded handsomely for the risk they take. Shuruk's launched a private equity effort already, but they're doing it currently in kind of a deal-specific model, right? I call it the InvestCorp model because they kind of pioneered it. InvestCorp historically did not have blind pools of capital, right? They source the deal, they then do diligence on that deal. They commit some capital into the deal, and then they syndicate it with investors. So it's sort of we put skin in the game model, but then syndicate on a deal-specific structure.
Okay.
And that works well in this region, particularly where a lot of the capital providers, family offices, ultra-high net worth individuals, they have a strong desire for discretion over their wealth. I think we all know, but this region has historically under-penetrated for passive capital investment. So mutual funds, hedge funds, private equity funds, this idea of a blind pool of trusting a manager, here's my money, pay yourself out of the gains, is less common. It's increasingly so. We've seen the growth and proliferation of venture capital funds and all. But ask anyone fundraising in the region, it's a tough place for that because just the culture of ultra-wealthy family offices and individuals is to have some level of autonomy and discretion over their capital, not to just hand it away to managers. And so as a result, these deal-specific fund structures are actually quite successful. Others do it too. GFH, Arcapita, like there are a number of these funds that put a portion of their own capital and then syndicate the rest to clients and relationships.
Yeah, that's what I'm doing too, by the way, on a smaller scale.
I was going to say, it's a great model. You do your deal, you source the deal in your network, due diligence, put your brand and some money in, and commit to it, and then syndicate it. It's a great model.
You already have a pool of people that are interested in investing, so you can just reach out to them anytime and get the money. It's an easier way to raise money, by the way, than going the blind pool.
Ironically, it actually has some advantages. People don't think about this, but the benefit of this model, any deal can work and you make carry. Not every deal needs to work and you make carry. Whereas in a blind pool, people don't, there's a double-edged sword. Yes, you get a
blind
pool
pool, let's just explain it to our audience a little bit. So this is when you raise a fund and you say, okay, I'm going to raise $10 million and I plan to invest in 20 or 30 companies over the next 5 years.
Within some mandate. Exactly
so
right.
I'm going to do fintech or I'm going to do MENA or I'm going to do something
and these
like
size
that.
stages and these size checks and here's my process and you get a mandate, a kind of guardrails, and then you deploy that capital. Typically, though, that comes with two economic drivers for the manager. One, a management fee of some sort. It can be 1-2% of capital per year that helps you keep the lights on, pay salaries, cover travel and expenses, due diligence costs, whatever, right? That's what the management fee is for. And then the most important piece is the carried interest, right? Where often it can be 20% of the gains of the fund. Now, the benefit of that, of course, is you have a...
Can we explain, carried interest a little bit as well for our audience?
Yeah, carried interest. Let's say I invested $1 and I turn it into $3. I would then take 20% of the gain. So the $2 gain, I'd get 20% of that as the profit. And that's the core incentive to venture capital funds, hedge funds, private equity funds around the world. That is the norm for high-performing funds. And it's a powerful incentive to be successful. But the thing that's interesting about the deal-specific model versus the blind pool model is that any deal can achieve a gain, and you get 20% of the gain on that deal. The other 10 can lose.
And then you pay back to the investors whenever you exit a deal. You don't have to wait until you have several exits to make a return.
You're exactly right. And so any given deal can have an exit and you get paid. In a blind pool, you actually you're keeping the tally on how the fund's performing.
Yeah.
And only after a certain level of gain is reached, they call the fund in carry. When a fund has met a threshold, can it begin to pay carried interest to the managers? And still it can be clawed back if the last deals somehow peter out or they were misrepresented in their mark in terms of how they were held. So in some ways, the blind pool has risk. The advantage is, of course, it keeps your lights on with the management fee.
Yes.
And that's what many asset managers are after, this kind of reduced risk profile of that.
Yeah.
But the benefit of the individual deal specific model is that if you're a good investor, you can get paid sooner. And of course, you get paid on any deal that you succeed in, as opposed to being held accountable for the ones you don't.
There's one risk in it, because I'm doing it, right? So my worry is that, obviously the startup investing economics, right? A lot of them will fail. Some will return some money. Some will return major money. We talked about exit and the lack of them, etc. So that's also another risk to factor in. But let's say, I bring Sky invests in one investment, and then that investment fails, right? So when you're investing in a fund, you're kind of diversified as an investor.
Very true.
So I meet a lot of people who made some angel investments, who wrote $100,000 check into a company and they got burnt. So that sort of scars them. And I always try to explain to people, listen, you have to invest in, 10 deals, 15 deals, maybe 20 deals, if not more, right? To be able to,
you're absolutely right,
for the economics to work. So that's the risk.
The rule of thumb is
model.
23 deals in multiple sectors, right? That's
23.
At 23 deals, and there's all kinds of studies on this, you start to reach the asymptote of the benefits of portfolio diversification. Okay. So you want to be in similar state, let's say from seed to B, and you'd want to do 23 deals in multiple sectors. And then you have a diversified portfolio, rough rule of thumb.
Oh, 23. Now, interesting. Okay.
Now, what I would say, though, is to your point, often I find a lot of startups raising capital saying, I won't take a check that's below 50 or I have a 100 minimum. Yeah. First of all, I'm like, nice luxury to be able to turn away money. Yeah. But secondly, you're actually possibly condemning that investor, because unless the investor is sitting around with $2.3 million to make 23 $100,000 checks, which is probably unlikely. I mean, very few of the people in the region of that kind of wealth to put in venture capital. Yeah. You're probably condemning them to not having diversification. So I often have advocated, people were very surprised. My first round at Pure Harvest, I think we had over 34 investors. Wow. But they were as small as $5,000 checks, and as big as $250,000 checks from a gentleman who was worth hundreds and hundreds of millions.
So you took a $5,000 check?
$5,000 checks. Actually, a couple of them, 3 maybe.
Okay.
But mainly, most of them were in the 15 to 50 range, right? And then a few hundred and 250. But I was definitely not a snob about where I got the check, because it was relative to the wealth of the investor. Yeah. I actually don't want somebody who's only got $250,000 to invest to put 50 grand in. Yeah. That's because, like you said, when they get burned, if they're going to feel it, you're going to feel it. And then on top of that, you probably condemn them not to want to invest in venture capital anymore. They'll have lost a meaningful portion of their portfolio.
Scars them. Yeah, absolutely. Wow, that's pretty interesting. Because it's a discussion that I keep having with myself about the models, right? Do you go for a blind pool? Do you keep doing syndication? What are the pros and cons of each and so on?
I think syndication is a great one, and especially in this region where people want discretion, they want to invest in things they're familiar with. You're not inviting somebody who knows nothing about semiconductors to try to invest in some new Egyptian semiconductor development or technology, because you're probably putting them into a risk they don't understand. Yeah. But I would say the benefit, though, is I would encourage people doing blind pools doing a deal-specific model to try to encourage them to have diversification. Yeah. Say, don't come and put a check only in one deal. Yeah. At least do 10, because you climb a curve of the benefits of diversification. And in fact, each deal is actually you're greater at 5. You're far better off than at 4. Yeah. And at 6, better than 5, and 8, and then eventually it flattens. There's a curve, and I can find this study for you. I'll send it to you.
Yeah,
but there was a great study
on
this,
actually.
But it sort of caps out at around 23.
Because I've done 16, and I was speaking. I was having dinner yesterday with a friend of mine.
You got to do 7 more.
Yeah. So I'm just thinking now. Yeah, I got to do more. And also, obviously, manage the expectations of investors, right? Because sometimes investors think, yeah, I'm going to put this money and this is going to become a unicorn. I'm like, no, it's maybe it might be a $200 million company or a $300 million company. I mean, unicorn, you would know.
Yeah. How it's pretty rare.
Freaking hard to build a unicorn.
Well, the thing is, it got so much media attention when the unicorns and decacorns were emerging.
Like, I think 7 in the region.
Yeah, and also historically, some fraction of 10 or 1% it's 10 basis points. So one out of 1,000 companies ever achieve unicorn status.
Okay,
and yet it was so high profile and so heated during the bubble, right?
Yeah.
That everybody just lost their minds, right? Everyone thought, oh yeah, every third company is going to be a unicorn. But it's such a rare thing to build $1 billion company.
It is.
Both venture capital and entrepreneur success is made between kind of the $50 and $300 million mark.
Yeah.
Right? Where you build a successful, profitable company that is attractive to be acquired or to be eventually a public company. And even public exits nowadays are larger and less frequent. So you have to be in the kind of 300 to $1 billion range to go public. And so it's a subset of companies that achieve these marks, right? So I think that you're right. It's led to kind of perverse expectations.
Yeah.
I would much rather, and maybe to the individual investors who want to invest in venture capital out there, and meaning young companies and support friends and family and you name it, do not invest in just one deal. Right? You need to, I would argue a minimum 20, but at least a minimum 10. And do smaller checks in more things instead of bigger checks in one or two things.
Yeah.
And now, unless you have some unique insight, you are very close to Mudasa or Magnus, and they're saying, put your life in this thing because they know it and they knew the sector and they're investing alongside you. But even then, just things go wrong. Sectors change, regulations happen. It doesn't matter how good your bet is. You need to have a portfolio at the level of your risk you're taking in early stage venture.
What's the ideal scenario here, Sky? I mean, you've worked in investment before you became a founder. You're friends with a lot of the VCs here. You talk to them all the time. Is it? Should we aim for like those $1 billion exits? Is that the end game, or how do you feel this region could build a healthy ecosystem?
Good question. So no, I don't. I think if we're aiming for these moonshots, the failure rate's going to be high. If you think about because
you have to take a lot of risk, put in a lot of money.
Huge markets. You need huge markets. So how many solutions, we have 57 million people in the GCC. Mm-hmm. And the broader MENA region, I hear different numbers, but 330, 350. Yeah. And that doesn't lend itself to dozens and dozens of multi-billion-dollar startups. It just doesn't because the size of the market. Now, if you're developing technologies for the global market, which is increasingly happening, we're Software. An example of that, or agribusiness. It's a global problem. But it would say then you have a potential at it. But even then, it's still a potential, which is a risk, right? So I would say people should be thinking, if we could get more $50 to $350 million exits and lots of them, and good, successful companies that build entrepreneurs who create wealth, those entrepreneurs go back into reinvesting and starting other things. Yeah. That's how we excite the environment. And I think that for the funds themselves too, a lot of these are young funds, fund 1 or 2 or 3. There's a very few older funds here, more mature, like Bico, right? But so the problem is these early funds got to work for you to be able to raise a subsequent fund.
Yeah.
And if these funds don't perform and fall out, it tarnishes the ecosystem and sets you back another decade to securing international and regional LP capital to build new funds. So I think to get it working, people need to think, I pardon the American baseball analogy, but swing for the doubles and triples, not the home run. That we need to play for good outcomes and that generate reasonable returns for both the investors and the entrepreneurs, rather than having to swing for the fences.
Interesting.
And ultimately, once these people have had a success or two, then you can swing for the fences. Yeah. Go after global problems. Go after big markets. Take significant risk. And you yourself and the investors who have been with you are capitalized to bear those risks, right? But I think it's important that people have sober expectations about what's possible and manage that with investors. If you're giving irrational expectations, this is a 30-bagger, a 30x investment in my seed company in a vertical market e-commerce business in Arabic. Really think about the market you've just defined and how big it is. And the chances that that seed investment is going to become 30 times its money, which is some 500 million plus outcome.
Yeah.
And then just look how many 500 million plus e-commerce companies have ever existed in the region. It's not a huge list.
Yeah.
And so it's not to say it's not reasonable to invest in an e-commerce business.
Yeah.
It's just unreasonable to give those expectations as the entry-level expectation for the investor.
I think the narrative, I mean, there was, I saw a clip recently on social media of one of the VCs here who runs a pretty massive fund. And basically, she was saying that I won't even look at a company that could be $100 million company. It has to be $1 billion opportunity. And I think, that narrative is, how realistic is that? I mean, again, the expectations on the entrepreneurs and also the expectations towards your LPs. I mean, how many of those are you going to have?
With respect to whomever this was, it sounds to me like somebody parroting something you've read in, a first round capital write-up or, possibly on some Masters of Scale podcast.
Yeah.
Because that might be true in America. Yeah. And even there, venture capital funds are looking at a diverse set of outcomes. You're trying to price capital to the risk. Now, without a doubt, it needs to be a large market.
Yeah.
You can't compound. Early stage wealth needs to not only, you need to invest owning some subset of the company, pick a number 18 to 24% in that early round. And then that has to bear dilution multiple rounds. If
18
you have
to 20%, and you think?
Seed rounds, typically.
A VC would aim for that?
On the low ends, ownership. I meant ownership, not returns. I'm saying you have to invest.
The VC would want to own 20% in the early round.
In a seed round, the norm here is 16 to 24%.
Okay, I thought it was more like 10.
No, it's higher here. 10 would be. I mean, it depends. I mean, if someone's raising 600...
10 because the valuations are quite high now, right?
Well, but even now, it's still, when you say high, it's not high relative to, for example, the United States.
I've seen around a first institutional, basically, check happened recently of 4 million at 40 million, which was crazy.
That's very unusual.
Yeah, I think it's an outlier, but still.
Yeah, I would say it's truly unusual. And also... I would caution the investor who made that investment, unless you really know your stuff.
They're common friends of ours.
Yeah, well, I would say there are sometimes hot companies where that can make sense, but that is a very significant valuation for a seed stage company.
Yeah. I know, but maybe that's why some investors would say it has to be $1 billion company, otherwise it doesn't make sense.
It absolutely needs to.
Because if you're investing at a 40 million valuation,
at a 40, if you need to be aiming for typically a VC needs to be aiming for kind of an 8 to 12x in the seed stage. Yeah. Because after you look at the graduation rate and after you look at the ones that will be dead, flat, zombies, right? Or then great outcomes, the blend of that needs to be a 3 to 4x fund, right? So the math of that works out that you need to be aiming for 8s to 12s, right?
Yeah.
But 8 to 12 can be on a $100,000 check in a company that becomes 300 million. It just depends how much dilution, what stage, you know what I mean?
Yeah.
So I think the idea it has to be $1 billion company is crazy. Now, but if you invest at a 40 million valuation in the seed round, it does need to be $1 billion company.
Exactly.
So maybe that's true. But I wouldn't want that to be the conventional wisdom for people.
Yeah, no, you're right. I think it's super important. To understand the nuances of this region and not to compare ourselves to like a developed market like the US, for example.
I have one other comment, though, to entrepreneurs to caution them on valuation, because I wish I was able to say this 2 years ago. And I can say I eat my own cooking. I'll explain it in a moment. People think higher valuation is good. Mm-hmm. It's not always good. A fair and good valuation and full valuation is very good for a founder.
Yeah.
But if you are overvalued, it can be dangerous.
Yeah.
And so we've seen that in a lot of companies funded in kind of 2020 to 2022, where they had big rounds in a hot market and they didn't deliver the growth or the milestones that they needed to justify the next valuation. And don't forget, what comes with those investments is often anti-dilution protection. You have a down round and you get crushed. And so now many of them are either unwilling or unable to raise new capital.
Yeah.
And so they're kind of stuck. Or they're afraid to, fearing they'll have a down round and wipe everyone out earlier. So big valuations are not necessarily a good thing if what comes with them is huge expectations that have some risk to deliver. And so valuations driven by just general market sentiment and costs of capital, that's tolerable because everybody gets them. But if you've kind of sold a dream and people invested a huge valuation expecting a dream, whoever this 40 million round is, if you miss targets and you can't raise in the next round at 100 or 200 million, it's going to hurt. You're going to regret that 40 you took. And so I caution founders to think bigger and bigger valuations is good. It's not necessarily true. It needs to be valuations that are in line with your growth curve and what your commitments for the next milestones to be funding for the next round, and also your ultimate outcome and expectation of what's possible, a reasonable, a market share in the reasonable estimate of the size of your market over a reasonable period of time. And if you don't get those things right, big valuations early on can crush you, and or leave you completely unable to access capital, trying to find alternative ways to pivot and grow to outgrow your valuation, right? And where I say I took my own cooking or eat my own cooking, when we took a $180 million capital raise a couple of years back, led by London-based and Korean investors, but then with some regional investors like Oleon who invested, at the time there was discussion of pricing us at a very significant valuation. Our sector was hot, the global capital markets were hot, and in fact there were some companies in America in our space that were valuing it, one of them was 1.3 billion, another was 2.7 billion. Both of those companies are now bankrupt, by the way.
Wow.
Yeah, AeroFarms and AppHarvest, right? They're both gone. And so at that time, I personally, and my own personal investment portfolio, literally sold everything and went to cash because I was like, the world is losing its mind. These companies are not worth billions. And even worse, that was right when the GameStop Robinhood trade happened. I don't know if you remember GameStop, the gaming company. I just thought the capital markets are inefficient and the world's lost their minds. So personally pulled back out of the markets just out of fear, saying that this isn't rational. People aren't pricing fundamentals right now.
You pulled.
I sold all my personal securities, everything went to cash.
In public.
All the public market securities, everything at the time.
Yeah.
But then at the same time, had a discussion with my investors and said, look, guys, if we price at too high valuation, one of us is going to get killed. And so we ended up structuring our investment as a convertible note. So we did what looks a lot like a safe, but late stage in the company. And why? Because we wanted a discount, no cap, but setting their valuation indexed off the next valuation, whatever it was. Because we both agreed after looking at the market's a bit irrational right now. So I could argue as well, $1 billion to $2 billion is a reasonable valuation. Look at these comps. But then they could argue, how does that have any relationship with the last 50 years of valuation? And I would say fair argument, right? So nobody was going to win in this discussion. We ended up doing a discount no cap with the floor. That never happens in what was essentially a Series CD investment. But because we both looked at each other reasonably saying, let's not price this company in a way that puts one of us terribly at risk. Right? So I really eat my own cooking on value. Higher valuation isn't always good. Now I'm very grateful I did that because the market corrected in our sector and globally. And right now I would be, if I had priced at that level, which was something approaching $1 billion, we would be in trouble right now. We would have completely no access to capital markets. We would have no ability to do anything. We'd be hogtied. And either the management would all leave, or we would have to, end up in some awful negotiation. So I want to say to founders, and the advice there is, don't get in the fervor of valuation as everything. Dilution is good and normal. Yeah. However, reasonable dilution. You want to make sure it's fairly valuing the prospects of your company. But in the end, you need to see these capital investors as your partners, not your adversaries, right? Yeah. They need to make money in their model. And you need to, of course, own some of your company in the end. And so, but it needs to be a reasonable negotiation of two parties, not this adversarial. You didn't win by taking them at a higher valuation. Yeah. That's just hype and madness speaking.
That's such great advice, by the way. Like that last bit that you said, it shouldn't be an adversarial relationship. You don't win by raising the valuation. But wait, you said a lot of things that I want to break down as well and explain to our audience. So let's start with. So have you had a priced round before?
Yes, in the
Pure Harvest. Yeah. So priced round is when somebody comes and says, this company is worth X.
Yes.
And you raise money based on that valuation.
Correct.
But you decided that you didn't want to do that because you were getting a high valuation from investors willing to invest in your company.
Correct.
And you said, no, that doesn't seem right. It seems too high.
Well, it seems risky.
It seems
that
risky.
We don't know how real. Like if I take that valuation.
So let's say they wanted to invest at, you said close to $1 billion, right?
Well, yeah, it was south of $1 billion and above 500 million.
750. Okay. And then you said, that seems too high.
Yes.
Which, by the way, requires like a shit ton of discipline.
Yes.
For you to be able to say that.
Well, I mean, I used to have their job. I'm a fundamentals person. I was looking at where our earnings were, where they would be if we deployed the capital.
And what did your investors
everything
say?
went perfectly, you could justify that valuation.
If everything went perfectly.
If everything went perfectly.
And obviously
it
nothing
didn't.
ever does.
Look at, for example, we were counting on being able to raise a significant amount of non-dilutive capital. So that's project finance, debt, etc. But then what happened shortly after we closed our round, the inflation of everything struck. And base rates went up 600 basis points. Cost of debt, capital markets imploded.
Yeah.
So everything we assumed about raising that debt, it went away. So we would have been crushed.
Yeah.
Right? We would have never been able to secure the non-dilutive capital that was meant to amplify the capital we closed to build a huge business. It would have never happened. So we'd be left with a smaller business and a massive watermark, right? A valuation that we'd be staring up at that tower of preference and say, we'll never meet this.
So how did the conversation with your investors go, right? I mean, somebody is coming to write you a check at a very high valuation to your investors. This is perfect. It's going up and to the right.
We had a discussion at my board, and I have to credit, I have a very sophisticated board, very calm and professional. Folks that are on it. Mahmoud Adi's on it.
Yeah.
David Scott. The folks from Metric and IMM that have joined, very sophisticated investors. Wafra, the Sovereign Wealth of Kuwait. So we all had a discussion about what this means, right? Hey, we have proposals and folks interested to invest on these terms, but then we look forward about the risks and rewards of those terms. As important as valuation is everything else: governance, preferences, what this anti-dilution protection. Mm-hmm. So those terms were what we were focused on because we were confident at the time in an exciting market with a company that had a great track record and had a fantastically large global market. We thought there's a real prospect here. But then are these terms acceptable? Like, do they give us a risk we can live with? Mm-hmm. And the fear was at a very high valuation with anti-dilution protection. Mm-hmm. If your next valuation is not an up round from a number like 600, if it's not an up round, you're in trouble. Yeah. Right. And that's where we had that discussion. So I would say the board, I think everybody was quite reasonable about it. We pointed to the signals we saw. Here's these great things happen, these de-SPACs of companies in America at great valuations. But what do they need to grow into to justify that valuation? Yeah. And maybe that's the insight. There are methodologies to stare at. What do earnings need to be to justify that valuation in a mature company? Mm-hmm. There's not to get too corporate financy, but it's called the Gordon growth model. Mm-hmm. But it's a model where you solve for earnings needed to justify a multiple. Mm-hmm. So if you look at your sector, and let's say I'm in fintech, and you say a mature, profitable fintech company that's public, and go pull up all the ones and say trades at this. Yeah. And right now that's still pretty exciting. Let's say it's 35 times earnings. Yeah. Great. Solve for the E needed at year 10. Like let's say I'm on a mature trajectory, and 10 years out, what's the E needed to justify that multiple? And then work the valuation backwards. You can solve what the value today can be within a range to achieve that if this is what you believe. Yeah. Now, if the number here, if what you're being offered is this, and what your solution says is this, trust corporate finance, right? There's something wrong between
so have
here
the discipline to say, no, it's worth this and not
Correct.
That. So then you decided to do a convertible note, which is basically like it's a debt instrument, right? That converts into equity.
Yeah, debt-like equity, right? It's technically still gets equity treatment. It can depend on the accounting treatment of it can depend on things in the debt. Yeah. If it's maturing or not, whatever. I don't want to get too technical, but generally it's equity.
Yeah. So it usually converts at a certain trigger or a date.
Exactly right.
Right. So it converts into equity.
Correct.
So the way you did it is you said it has no cap, which means that there's no number or a value to the company, but there's a discount to the next round, right?
Correct.
So that's what.
And then we also put in a floor.
And what's the floor?
Floor is the number we won't communicate, but it was it was a substantial floor, but it was a floor that says. Because you brought up an important one. It was essentially 2 years from now. Yes. Within 2 years, we will reprice the company. When that happens, there will be a discount to that, which is what you price at. Yeah. So, but if we don't price, we don't get to wait forever. There's a trigger at a date that becomes the floor valuation.
Oh,
And
I see.
and that's how we
So
solved
the floor is the minimum valuation that
Exactly.
that instrument would convert into equity.
Exactly right. So they
Okay.
know they have up to this amount and something less. But the theory of that and why that structure works so well
Yeah.
is if you hit your milestones, you'll price at something higher than the floor.
Yes.
If you don't, you deserve the floor.
And the floor is the previous valuation, or how do you determine
it was
a floor?
agreed based on a set of analyses and fundamentals, both of us staring at the business plan saying
Okay.
what would justify this valuation. And it was one they're comfortable with as sort of the minimum ownership, right? Or sorry, in their case, the way the floor would be triggered is you either A, weren't able to raise capital, or B, you ultimately didn't need to raise capital.
Yeah.
So it motivates you out to the market to raise capital because they need something to price them.
Yeah.
Imagine they don't want you to sit on their capital for years and years and years. You exit later at $1 billion company and finally price them, and they price at some discount to $1 billion.
Yeah.
Not fair to them for the risk they took, right? So the way this worked by giving a period of time,
Which is usually 2 years.
two.
Yeah.
I've never seen longer than 2.
Yeah,
It can
yeah.
be shorter, but usually 2.
Yeah.
And that because typically rounds are every 18 to 24 months.
Yes.
So you set a line and say you will reprice by here and a discount to that.
Yeah.
And at the very least a floor. And that structure works very well.
Yeah.
And of course it accommodated that we got the sizable amount of capital we needed, let the market calm down and settle. Turns out we were both right. It was chaos. Now, unfortunately, markets settled at a much lower level, but also our sectors had unique challenges, right? And many of these players that made huge, audacious promises about their scalability and the amazing things they would achieve have not done so. In fact, many have gone bankrupt.
Let's come back to the sector I'm going to talk about, but let's just finish on the valuation piece, because I think there's a lot of learnings here. Because I think the terms, right? You talked a lot about the terms, so it's not just what valuations you're raising at, but there are all the other terms like anti-dilution, for example. So can you talk to us why had you raised at that valuation and not been able to achieve like the perfect scenario that you had envisioned? And you said like we would have been wiped out. Like
Yes.
what do you mean by that?
So anti-dilution protection, there are many kinds, but basically they all achieve the same thing, which is the investor who invested, if you have a subsequent a valuation event, a pricing event, or sell the company,
Yeah.
and it's at a value lower than the valuation that they invested at.
Which is called the down round.
Yeah, it's called a down round.
Yeah.
They would call it colloquially. They get handed more shares and more shares to make them equal to what they had before. It's like the opposite of a pro rata right? It's that you are required to give them more shares to make them whole for the damage that occurred due to the lower valuation from where they invested. Now, if that's substantially far and you have multiple rounds of capital that all have anti-dilution protection,
Yeah.
it can be a pretty far race to the bottom, right? You can end up handing, all of a company, but it can be substantial portions of the company over, leaving very little to remain for you, the founders, or those involved in the common.
Yeah.
And then, of course, you have the dilution of the actual new capital you raise.
Yeah.
Right. So a down round can be quite punishing. If it's modest, it doesn't have to be. But if it's significant, if you massively overvalued your business before and didn't achieve milestones that justify a higher valuation, and or the market turned against you, meaning valuations are down even for the same success, it can be painful.
Yeah.
Now, one final piece of advice for those who have already done that, though, like if you have already done a high valuation in 2020 to 2022, and you're now staring at that and realizing we're in trouble, the best thing to do isn't to wait for your next valuation. Go negotiate with your capitalization table. Sit down at a table and stare at each other and say, what do we do about this? Because when you have kind of a contaminated cap table, you have an investment that's sitting here, you can't raise at any reasonable valuation without crushing everybody. Not only is it not exciting for the managers and the founders to be leading a business where they're probably not going to own any, but secondly, the new investor looking in is going to see that. And if you delay that negotiation to then, you have to continue to do the work to build your business, and then you've got to enter this new negotiating party at the table that is an unknown, right? Whoever this new investor is. So typically it's warrants to just sit down with your lead investors and say, look, we all know where we are. Let's have a conversation. You might be able to restructure those terms. You're going to have to give something. You better be ready to, for some bloodletting because it's owed. Because you wouldn't have been renegotiating with them if it went well, right? You wouldn't be like, sure, you know what? You're right. You paid too much. Here's some more.
Yeah.
That would never happen. So you need to do this ethically. But I think it can be advantageous to proactively address that problem before you try to raise capital, because it can affect the risk of raising that capital.
Yeah.
Right. So it's in both parties' interest. There's no benefit to the existing capital of sitting on it now knows it's in the money on a down round, right? That's not what they wanted.
What is in the money on a down round?
Meaning that they know they're going to be given more shares, that there's going to be anti-dilution protection.
Yeah.
But that wasn't their interest. They didn't invest in you to watch you struggle and get more company, right? They're not in the restructuring business.
Yeah, yeah.
So you'll tend to find you have a very open-minded partner who wants to sit with you and say, how do we make this work?
Yeah.
Because especially if they believe in you as a management team, they want to back you to fix this, to make their capital good, right? So I just highlight that's my one piece of advice to entrepreneurs who are in that place.
Because I think if you do that proactively as well, it's not an overhang on you as a founder. You're not sitting and thinking, oh my God, what am I going to do with this? And
where's your employees are marching out the door? They're all saying our options are out of water. Why are we here?
Yeah.
Let's go work somewhere else.
Yeah.
Yeah. You start to have like a leaky faucet. I think it's far seriously. It's far better. It's far better to sit with everyone and say, look, we're going to go talk to our board. We're going to fix this. But I ask you to do so humbly, because you need to talk to your capital. You took their money.
Yeah.
You didn't deliver, or the market changed.
Yeah.
But would it have gone the other way? If the market crushed it and you crushed it, would you be handing them more shares? Oh, you're right, you overpaid. No. So you need to have a little bit of humility about how you got here.
Yeah.
But the truth is, fixing it is in everybody's interest, right? Yeah. It's in the investor's interest. It's in yours. And also ensuring that you have a management team that's motivated and has clarity on their path to being in the money, or to being participating in the value creation that they're ongoing, right? You don't want to leave them demotivated. Oh, our options are struck at X and we're never going to see that.
Yeah.
What's the point of being here, right? That's not useful.
And as you said initially at the beginning of this discussion, like, the relationship doesn't need to be adversarial. Like, you're not against your investors. You're sort of working together.
You're quite literally in it together, right? The moment that you took their money, their reputation, their carry, as we talked about earlier, is at stake in you. So your incentives truly are aligned, right? And I agree with you. I think it's to not treat them as adversaries, right? They're meant to be allies in helping you achieve your dream and building what you both committed to set out to do.
But you do see some predatory behavior on the part of investors, right? When they see like someone struggling, they might put terms, they might re-up their investment, but on pretty harsh terms.
Sure. Well, I mean, sometimes the terms are warranted. But I would say, yes, you can see it. It depends on the experience level and the quality of the investor and all. Yeah. But I would also say often founders are framing anything that's not in their favor as predatory. And it might be well warranted, right? Greater protections, the ability to throw you out, right? But all of these things are very reasonable. Yeah. If you've taken their money and underperformed and not delivered plans, you should, be watching your head, right?
Yeah, that's amazing, by the way, because you don't see that often here. And that's something I also spoke about with Abdullah Mtawi. I don't know if you know him. He's a partner at Taylor Wessing. So he works a lot with VCs and founders who are, and obviously these types of situations. By the time you're talking to your lawyer, obviously, there must have been some discussions to have, but you obviously didn't have those discussions. So he was saying that boards don't necessarily have these difficult conversations, like replace a founder, for example. But you're right, what you said. I mean, it's within their rights.
I would agree. So I also think an active board should, right? They should be coaching and supporting the management team. Yeah. Like, just in general, one comment on boards, I think is in this region, and maybe it's just, again, the nascency of the entrepreneurial and kind of private capital ecosystem here, but boards are not meant to be your adversaries, right? They're not your police, right? They truly are governing on behalf of their capital, or if it's public capital, they're supporting the management to guide strategy. They're as accountable as you are to the performance of the company, right? It is meant to be, they're an added layer of expertise and direction in the company. They're a sounding board for the CEO and the leadership. They are not adversaries or police officers, and there is a culture of cops and robbers here, which also incentivizes the management team to behave as robbers. And so it's not that you really, the relationship with your board should be a regular cadence, keeping them deeply informed on the prospects of the business and what's happening, good, bad, and ugly, information early and often, right? And that relationship, if it exists, it makes it a lot easier to handle problems like what we just talked about when you face them. You already have an open dialogue. You've brought the problems before. It's not the first time you're ever confronting an issue with them. Too often, I feel management thinks they have to put lipstick on and try to pretend all is okay.
Yeah.
We're up and to the right every day of our lives. The boards are not that naive. And so change that relationship or establish that relationship from day one, a regular cadence of meetings, a standardized agreement, and get their buy-in on what you'll present to them every period in your periodic updates. Actually bring them problems and say, I like your input and buy-in on this. Help me think through it or buy into what I'm doing here so that you own the failure as much as I do or the success, right? And if you build that kind of rapport with them, it's a higher functioning board and one that's prepared to tackle big problems like what we just talked about, right? Whereas if it's the first time you're bringing them a problem or it's probably already an adversarial relationship and it's one where you're going to leave feeling like it was predatory, quote unquote.
That is fantastic advice, by the way. I'm invested in a few companies. One of them has had some trouble recently, and they didn't communicate that there were like some issues. And then one day I get a call, basically saying there's a problem, and you're just like, wow, okay, this is a big issue. This didn't just come up. So this must have been brewing for, 3 months, 6 months, whatever. Why wasn't this communicated? And I don't think, the founders do it maliciously. Like I think it's probably they think that they always have to report positive news.
Yes.
Why? And this is a misconception, right? I think all investors would understand that there's going to be ups and downs, especially if someone who's a founder like me, right?
Yes.
I've been through the journey. I know.
Agreed.
So what you said is, I think, fantastic advice. You don't have to always report good news. Use your board. And when they told me about the news, and I said, fine, what's your plan moving forward? Talk to your biggest investors, because I'm not like one of their biggest investors, and get their buy-in. Because they also feel like they have to problem solve on their own.
Yes.
Like, okay, I'm in this mess. I'm going to work it out. And I'm going to tell you in 2-3 months if it worked out. No.
I would agree with you. I think that too often they feel, again, they have to contain their problems and not tell their parents what's wrong.
Yeah.
Better is, I've identified a problem. Here's how I'm thinking about it. Here's the 4 alternatives we see in the work we're doing to validate them all. I'll be back on this date with a recommendation. Do you see the problem differently? To see anything else I should be thinking of? They might actually add value here, right? Especially if they're experienced. And then they're in it with you and they're informed to make a decision when it comes. Yeah. If you suddenly call them out of the blue thinking they're here to make a decision for you, they have lives. They have busy things. Yeah. They might have travel. They're not just waiting for your fire drill, right? Yeah. And so better is that you alert immediately and then you guide them through your thinking process and how you're going to tackle the problem. The other thing about that is that also is what instills confidence from a board that they have a management team that is backable in good or in bad.
Yeah.
It's when things go bad that you don't get thrown out and because someone else must be better, right? Is what the mentality will be. As opposed to this is a person or a team who reacts to the challenges in front of them, lays out viable strategic alternatives, engages, does the work, and keeps us informed and involved. That trust through thick and through thin is what will keep you at the helm of your company when problems happen. You do that whole call me last minute. If I were on your board and somebody who said, call me at the last minute with a crisis, one that was either unfixable or fixable at great consequence. And it's the first I hear of it.
No, unfixable, because by the time I got the call, the decision was kind of made.
They wouldn't last long. I think that's an example of where you'd say, I don't have a management team I can trust and back.
Yeah.
And now, if it's inexperience, it would be a coaching moment and then say, don't let this happen again.
Yeah.
But I would say that is not acceptable behavior, right? In the end, the management teams and founders need to say, I took someone's capital. This is somebody's savings. Whether it's an institution, it's someone else's savings. They're just managing it.
Exactly.
But this is somebody's hard-earned wealth sitting in your pocket, and you have responsibilities to that, including disclosing good, bad, and ugly. The final comment is don't deprive them of their learning moments.
Yeah.
Board members and investors, you will invest in many things. You learn more from the bad ones than the good ones.
Yeah.
Like if when everything goes great, you pat yourself on your back. You're like, I'm brilliant. This is a fantastic career. But when things go badly and you have to make hard decisions and restructure and pivot and end, that is when you define yourself and you build your acumen and you build your strategic knowledge and you dig into your relationships and your bench to help deliver an outcome for a company. That is what forges great investors. So also to the entrepreneur, and I doubt many entrepreneurs are thinking about this, what is the quality of the experience your board is having with you? Right? Like, are they learning from your company? Are they enjoying being part of it? Do they feel part of it? If what is, I have your money and you're like a nuisance to me, imagine how that feels being the board member, right? Because that's sort of how I often hear boards talked about here, like, oh, the investor, as if there's some other. You have their money in your company. They are one and the same. They're part of your company now. And until their journey is over and you've hopefully rewarded their capital with return, you work with and for them. Right? They don't work for you. And so I think that's an important thing for people to understand and personalize that perspective on capital. And the more we do that, I think the more founders will be responsible with people's capital, which goes back to leading to more successful companies, more exits, and building our ecosystem.
I love this. Like give your investor their learning moments as well. You're absolutely right. Because also part of investing early, and that's what I tell the investors that come with me when we invest in early stage companies, is that, look, we're also doing this as a learning opportunity. And actually people love that.
Yes.
Because a lot of people in the corporate world that are putting in this $20,000, $25,000, $10,000, $50,000, whatever it is, they are very curious and interested in the startup world.
Want to be part of it.
And absolutely.
And to rob them of that.
Yeah. I'll end with one comment on this. I heard Mudassir say once, I think it was at a conference or something, where he said, he's the co-founder and CEO of Kareem, where he said he goes to investors with a list of things he needs from them. So basically make your investors work for you as well. Like make them part of what you're building. It will make them happy.
I couldn't agree more with Mudassir. We actually have a section of we do a quarterly shareholder letter. And in that letter, it's what we need from you, right?
Yeah.
It's, we are hiring these people. Do you have someone in your network? We are doing this. We're raising capital. Can you reach out if you're interested or if you know someone, you know what I mean? So yes, we task the investor with their homework and ask them to engage and help us.
Yeah. I think you've built an amazing brand. I've been buying your tomatoes ever since we met 4 years ago. But now I also buy blackberries, strawberries, salad mix. My husband thinks... like you definitely do some magic in those tomatoes, because he tells me, ask your friend, what do they put in those tomatoes, because they taste so good. So
Thank you.
Yeah, you've built a wonderful brand. And every time I walk into a supermarket and first of all, if there's no Pure Harvest tomatoes, I don't buy tomatoes.
Thank you.
I don't know how many people do that. So congrats.
Thank you. It's been... they always say it takes years to build a brand and just one activity or one day to destroy it. So it's something we're trying to protect. But a mission-driven brand is what we set out to build. Yeah. And I know you know this from the beginning. But really, you can tell your husband the sun is what does it for us, right? Ultimately, photosynthesis, or the plant material, is made from light, CO2, water, and nutrients. And we have a lot of sun and a lot of CO2 here. So it's I knew we had the raw materials to make some of the greatest produce in the world. Now we've proven we can do it. And I think as you've tried, not only the tomatoes, our blackberries are quite famous now. Our
I've had the blackberries, but they're not everywhere, by the way.
No, we limited production. We're now seeking to scale. Part of the reason we're raising capital.
Okay.
Once again, the joy of Pure Harvest, though, is that it's a capital intensive. We're building food infrastructure, right?
Yeah.
And so we're having to raise capital, then deploy capital, raise capital, deploy capital. And we're now in the raising phase because we're tapped out. We have over 280,000 square meters of production capacity now.
This is between UAE and
Saudi Arabia, producing over 15 million kilograms a year of produce.
Wow.
But we're tapped out, and now we have a lot more demand than we can fulfill, which is a good problem to have. But of course, we got to build the next units to have additional capacity.
So why isn't money being thrown at you? I mean, that...
Very good question.
That sounds like, first of all, an amazing brand, fantastic founder and board and advisors. And we have deep pools of capital in this part of the world. So why aren't you...
Very openly, it's a challenge.
Doubling production like every year
Every
or
year. Well,
something
we
like
hope
that.
to double if we secure this capital. But no, it's a couple of things. Let me start with the macro. In the end, we are heavily, like one of the things that affects a business like ours that's infrastructure is the macro. So things like inflation, and specifically inflation struck building materials. So the costs to build over the last many years rose significantly. Things like steel, glass, aluminium, copper, and these are in the infrastructure. So the CapEx bill per meter rose, right? And then you ask yourself, did the price of produce rise commensurately?
Yeah.
Interestingly, no. And back to macro, our region, partly to stabilize food prices, it's a double-edged sword that we're such an open market because we literally are the world's dumping basket of anything, for example, in fresh produce. Because, for example, we've had significant growth of the imports of produce from Iran. Iran is a nearby neighbor with a better climate, farming at a much lower cost than we farm here. But it's essentially also hungry for US dollars. So, and food and medicine are exempt from sanctions. So they've been their growth in exports of food have grown considerably. And this region has been buying it. And so that's a powerful deflationary force on the prices of food. At the same time, you have an inflationary force in CapEx, right? So these macro dynamics spook investors.
Interesting.
But then the other thing, we've had some bad actors in our sector. Our sector was really hot a couple of years back, right? And it was a lot of excitement about ag tech broadly, and I'll say, but including controlled environment agriculture, the specific area of ag tech that we sit in. Now that area, some companies raised huge amounts of capital. Infarm in Germany, with QIA investing, raised, close to $1 billion and over $1 billion valuation. If I remember, over $2 billion valuation. You had AppHarvest, $2.7 billion valuation in America and a de-SPAC, and raised a ton of capital and a pipe. AeroFarms raised hundreds and hundreds of millions. Plenty has raised $900+ million. And of these companies, almost Ironox, all of them are gone, but Plenty's still alive. And why is that? Well, a lot of them, they were what I'd call a solution in search of a problem. Oh, they were technology that was way over-engineered for the fact that they ultimately produce a fresh produce commodity that needs to compete against alternatives. Field-grown, low-tech, controlled environment ag system grown, imported from around the world. And they just lost the relationship between the price of the ultimate quality and price of the good and its cost of production, because there was so much excitement about the tech. And that was partly the fault of the capital markets at the time. The world was flush with cash at 0% interest rates, seeking homes. This was a new, exciting tech sector where you could deploy hundreds of millions of dollars when that was a problem for funds they were trying to deploy. So this perfect storm of, inflationary dynamics and affecting interest rates. So borrowing costs went way up, which affects us in project finance. The macro of controlled environment ag and some kind of bad actors taking a lot of money and losing it all, and then coupled with some regional dynamics, specifically folks like Iran dumping fresh produce around the market. This triangle is marring what is an otherwise fantastic story. We're profitable, we're scaling, we have a truly large global addressable market. We essentially are both climate mitigation and water mitigation, right? Which should be both wildly investable themes right now. But there's an element of baby with the bathwater, right? Which is making it challenging. So not to say we are receiving investment proposals and proceed.
What is baby with the bathwater?
Have you ever heard the expression
No,
of baby? So don't throw out the baby with the bathwater as an expression. And what they mean is when something looks bad, don't throw everything out because the baby might be in the bathwater, right? You're tossing the baby and the dirty bathwater. Okay. And so that's where the expression comes from.
It's pretty graphic.
Yeah, it is pretty graphic. But there's an element of the baby with the bathwater happening in our sector because there's still great companies that are performing. We're not alone, by the way. Little Leaf Farms in North America is a similar controlled environment ag company, doing fantastically, growing, great farm level and unit economics.
Yeah.
Another company that's really made a turn, Gotham Greens, had started earlier with higher cost farms, pivoted to become kind of more like us and like Little Leaf, and is doing well. There are players, well-established controlled environment ag companies that are doing great. Nature Sweet in North America, $800 million of revenue. Mucci in Canada, Azura in Morocco, Costa just got bought by Driscoll's and Payne Schwartz, a private equity fund in Australia. And around the world, these wins are happening, and nobody wants to hear about them because all they're afraid of is these really high-profile disasters. Another example, just a few weeks ago, another vertical farming company called Bowery that was funded by Temasek and others, GGV and others, also went bankrupt. And so that noise, it's never easy to raise in a sector that has bad news. Because think about it. Let's imagine you're the venture capital partner or private equity partner looking to invest in my company. And you've got to go advocate to your IC why this one's different, right? Ignore all the things you're seeing in the newspaper today. This one's totally different, right?
But the other failed because they were bad actors or because the unit economics didn't work?
Well, I'd say bad actors. I mean, they were, it's a combination.
Were they selling a wrong narrative?
Snake oil. It's snake oil, yeah. I mean, for example, making arguments, it's a mix. Some of them, I think they believed they're snake oil, right? But they were making arguments like LEDs have Moore's law. Have you ever heard of Moore's law? It's in semiconductors that if I recall, it's the power of a transistor. With each generation, the power of a transistor would increase, right, by double. And it was for a long time this happened. This massive improvement in the.
So you have lower power requirements but higher output.
Correct, and doubling every generation of the technology, right?
Okay.
And this Moore's law was from Intel Corporation, and it drove semiconductor economics for many years. So they were saying
our cost.
They were saying
is going to go down.
They were saying LEDs would have the same, which is the light emitting diodes that essentially are used for artificial light in vertical farms.
Yeah.
But there is no Moore's law of artificial light. Like it's never, there is nothing proven, there's no data. But it was sort of this intuition of, well, tech will solve that. You know that unit economics issue we have? Tech will solve that.
Yeah.
It's sort of like when Elon Musk run around saying, no worries about population because we'll all go to Mars.
Yeah.
Tech will solve it.
Yeah.
And I still worry about population. I don't think that counting on Mars to save us is a good idea.
And by the way, he keeps doubling down on this. I don't get it. Like I saw we're going to be 10 billion people by 2050. And he keeps doubling down on this, like, we need more people. Granted, there are some countries where there is negative growth, right? Where I think like South Korea, and I think there's like a few countries where, the population is not growing, but like 10 billion people on that.
Yeah.
By
the way, I'm happy to talk about that one because I think it's madness. This idea, I get the idea of aiming the moonshot at Mars, saying the work and technologies we develop with that aspiration will have incredible benefits on society, around humanity, as has the space race. We still enjoy some of the technologies and issues or innovation that occurred by the space race. But if aiming to Mars is so that you can drive investment towards SpaceX, good for you. But if you're actually convincing the world that population isn't a problem, then that's criminal. It's not responsible. And so I think that I'm not sure what the actual goal is. Is it to say, hey, let's get investment towards SpaceX and let's drive innovation, which is a great goal. But again, if the collateral damage is you're actually convincing people population's not a problem, let's all breed.
Yeah.
That's scary. And there's huge environmental and human, health and population health and food statistic or food availability challenges to solving that goal of let's just breed unlimited humans.
Yeah.
But back to what with Pure Harvest, I think that there was a mix. I think some people knew their unit economics were quite rough, that sort of their business model became fundraising, right? Raising more capital for the next thing.
So who's the next guy that's gonna kind of like pass the potato, right? Like who's the next person that's
greater fool, the greater fool. But I have all these amazing investors behind me. I remember early on, I joke that vertical farming specifically, but to be clear for the audience, controlled environment agriculture has been around for a very long time.
Which is what you do.
Well, it's a broad set of, it can be everything from a stick with a net blocking bugs, right, to drip irrigation, all the way to what vertical farming, which can be artificial light in a closed structure with automated climate control, robot harvesting, and artificial intelligence controlling the irrigation, fertigation strategies and everything. Both of these are under controlled environment ag.
Okay.
And there is a broad spectrum of solutions in between. Even in this region, there's been greenhouses for a long time. They're typically lower tech plastic structures pattern fan cooling, but they are controlling the environment and improving productivity, right? But there's a massive list of tools and technologies between here and here, right? Now, what was being sold during the peak of this industry was that this vertical farming technology had been discovered. Admittedly, it's been around for a while. There was a powerful narrative about climate change and et cetera. So it was so on theme, it became people just, and when you got a couple early investors like Innovation Endeavors, which invested in Plenty, which is Bezos, you got some big names that came in early on. SoftBank put in gobs of money in Plenty, and it led to this hype and fervor, and just nobody. It's like the other guy must have done his homework. You get what I mean?
Yeah.
And so me too. And nobody was digging into like why. I remember being asked on the way up. I engaged with Vinod Khosla heavily. I flew out to meet him a couple times, who was looking to invest in Pear Harvest in the seed round. And unfortunately didn't. If Vinod, if you ever listen to this, I wish you would have. But what happened was these announcements of these, folks like SoftBank investing in Plenty happened. And it just killed my process because a lot of people said, you know what? This just isn't techy enough. It's system integration that you're doing. You're acquiring intelligently technology, and then we developed a software to control the climate systems. But they were not wrong. Our early pilot was a Frankenstein system integrated tool.
Yeah,
So imagine the Arduino
own...
board of a greenhouse, right? Where it's sticking stuff, plugging it in, and saying, "Does this work?" as a proof of concept, right?
Yeah.
But still, at millions of dollars to build a pilot. Now, I thought, of course, this is IoT-enabled agriculture. Mm-hmm. I'm buying the right tools and integrating to solve the specific problems that make this possible here, and I'm going to prove the economics of that and the unit economics of production. And while I was racing for that, people are announcing, no, we're going to use AI, and the Moore's law of LEDs is going to drive this, and it's going to be the panacea to food. We'll produce anything, anywhere. We'll standardize the production of these things and stamp them out all over the world like that. We're the Tesla of vertical farming, right? And everyone was throwing money at it. And I remember then everyone's like, you're not techy enough. And it frustrated me because I'm like, well, in the end, I'm the right tech. I'm building the right solution, and my cost of production makes sense. And then we actually proved it, right? We actually, after our first build, fantastic product, good unit economics. You could see that if you scaled these facilities, you would absorb those. Your gross margins were high enough to cover your fixed costs and develop a profitable technology-enabled, consumer staples business. Mm-hmm. And we were able to raise capital and build. However, now on the other end, when we're now at the larger raises, all of those guys are going out of business, and all these investors are all burned, saying, we'll come back to this sector in a while, right? So I feel like vertical farms harmed me on the way up and the way down. And so, because now it's having to explain, I spend half of the meetings now explaining why I'm not them, right? And to be clear, I don't want to totally crap on vertical farms. We build vertical farms. We do use vertical farms. For example, in our leafy greens production, in the early stage, from when it's a seed and germination occurs all the way to when it's a baby plant, we do this in a vertical farm because it's a very controlled environment at a very sensitive time in the cycle of the plant. And then when it's kind of a teenager, we move it into prime time, into the sun. So it's a hybrid farm. We embed a vertical farm inside a high-tech greenhouse, for example. Another example, we built a vertical farm to do really high-quality exotic Korean strawberries that will hit the market in February. And we're also doing animal fodder, so feed for cows and sheep in a vertical farm. So there are times when the solution makes sense and is the right tool, but it's 2% of the global addressable market, not disrupting the world's food supply. And that challenge has created a uniquely difficult fundraising environment or capital markets environment for this sector. What I'm trying to spend my time doing now, and have been in our investment process, is educating people on all these less sexy companies you've never heard of that are out there doing CEA at massive scale. And those were the names I mentioned to you: NatureSweet, Mucci, Mastronardi, Azura, Bright Farms, Gotham Greens, Costa. There are a number of firms that are between kind of $200 million and $3.7 billion of revenue. Driscoll's, Berries, they do both field farming and CEA, controlled environment ag. And all of these companies you just didn't hear about because they weren't on the front page of the Wall Street Journal with artificial lights and discussions of AI and robots, right? And that is we're just one of the sectors, we're not the first, that had a hype cycle. And now we're in the trough of disillusionment, right? In the classic Gartner hype cycle. And now what we've got to do.
Trough of disillusion.
Yeah, they call it the hype. There's like a peak hype cycle, and then you enter the trough of disillusionment.
Yeah.
And then it's sort of this plane of enlightenment where investors are now enlightened on what actually works and makes money and doesn't.
So they've seen the whole cycle.
They've seen the whole cycle. And what happens is everyone gets up here, a bunch of people invest and lose. Then no one wants to invest. Rationalization occurs in the sector, and then the technology emerges to what is the actual winning solutions, stable companies attracting capital at normal returns. And that's where we're coming out of the trough of disillusionment now.
So how does that impact you as a founder, right? Because you said you're profitable, but also at the same time, building farms and producing more requires a lot of capex. So how is that impacting you? You can't grow.
Well, we're sort of limited. Actually, in some ways, it's been beneficial. It's created a lot of creativity and internal focus on how to grow capital efficient. So I'll cover two pieces of that. The challenge is we have a huge portion of the capacity of the company that is about growth. So engineering, construction, project management, et cetera. And you need to deploy these people. So we've done that. And we had acquired Red Sea farms in Saudi Arabia last year, retrofitted that system and redeployed it. The vertical farm actually opens in January. So we were building that, right? But what's next? We want to redeploy this muscle, right? We have this capability to grow, but it requires capital. But the benefit of when you're starved of capital or when it takes time to secure capital is that you get creative. We've redeployed our energies to how do we get more out of what we have? And not only in yield improvements and R&D, we do that all the time. But in creative things like we launched this sauces business and the value-added products. So we call it value-added products. It's taking our wonderful quality tomatoes and strawberries, taking the product that is sort of ugly, wouldn't be sellable at first quality prices in retail, and we turn it into a shelf-stable, high-value good. We've talked about doing that for years. This year, we deployed that effort. We took because we weren't building 3 or 4 projects over the world, we redeployed the energy and the people into launching this effort. And now we've entered the market with these sauces. I don't know if you've tried them yet.
Haven't tried them yet.
They're fantastic.
No.
We're doing a cherry tomato passata, marinara, a chili cherry, and a shakshuka that is just add eggs.
Yeah.
And all of these are kind of, both for convenience and delight of consumers because it's using our quality tomatoes and many varieties into a sauce that is prepared, right? And people are, so far, it's having incredible reception. We're also launching a line of jams. So we're doing a strawberry jam.
Oh, that'd be awesome.
Yeah, they're preserves, right? So over 60% strawberry content, which is really high. So lots of fruit.
Yeah.
And we're also doing strawberries, dates, cardamom, and cinnamon. So dates being, of course, culturally and ethnically relevant. But little did I know, a strawberry date jam is unbelievable.
Really?
It's really good.
Never tried that.
And hopefully soon it hits the market in end of January.
Strawberry dates jam, okay.
So strawberry dates, cardamom, cinnamon. And then we're doing one that's strawberry, vanilla, elderflower, and anise. So it's kind of, we're targeting multiple palates and cuisines and how people use these things. And we'll have so that's an example of something that took very little capital, a lot of work, a lot of ingenuity, brand effort, of course, supply chain, reallocating where we're moving that product.
But isn't that capital incentive to produce it and distribute it?
No, we partnered with a food manufacturing partner.
All right.
So it's a partnership.
Okay.
So that's an example of where we're leveraging our intangible assets, our brand, our know-how, our relationships with the retailers and our credibility and to launch new products with them. And then we're working through a supply chain in a capital efficient manner. The only capital is working capital, which is pretty efficient. That's an example. Another example, we launched Pure Harvest Selections. This is where we use our agronomical knowledge, so our growing expertise and ability to diligence and understand farms. We study partner farms. We'll support them in technology adoption to improve their farming methods, even procure and engineer for them if they wish. Alternatively, just provide advice. And then
this is the traditional farmer?
It depends. It depends on the product. So, for example, a traditional farm would be avocados, where we've bought avocados out of Kenya and South Africa, supporting these farmers to access the GCC market.
Oh, this is not local.
It depends. Some farms are local, and some are also regional. So markets like Jordan, also Morocco, Tunisia. So what we're doing is retailers need to source beyond what Pure Harvest supplies.
Yeah.
And again, we'd love to supply them everything in the world, but you need unlimited capital to do that, which we don't have access to. So what we do is we know they're going to source somewhere. What we'll do is support them to source responsibly, to validate and verify that both quality and production methods of the farm that is in question, support the farm to improve its farming methods, water efficiency, use of pesticide, things like this, and then certify it with a brand we call Pure Harvest Selections, not Pure Harvest. We want to be clear to the consumer what's farmed in our farms and what's sourced. But in Pure Harvest Selections, it's almost like fair trade certified, right? Like coffee. And then we do that. We provide value to the retailer, de-risking them from their supply chain and sourcing only the best farms. We provide value to the farmer, not only in upgrading their farming methods, accessing the market, but also better working capital. We pay them fairly and on time. Historically, this region has some abuses.
We
pay the farmer.
All right.
So because this region has some abuses in how it, historically sourcing from all over the world, paying very long term, 60, 90, 120 days. And these farmers are often starved for capital. So it's quite a predatory practice. So we instead pay them usually in 15 days, sometimes 30 or 40 if they're a larger farm. So we're providing value on both sides and essentially leveraging our brand, our capabilities, our agronomical knowledge, and our access to the market to create value for both sides, right? And for us, that also runs more revenue over a fixed cost structure, increasing the profitability of the company.
I think that's also like one of the limitations of controlled agriculture, right? Because you have to meet a certain price point, as like the produce needs to be sold at a certain price point so that you're able to cover your costs.
You're exactly right.
So you can't really do rice or corn or
exactly. You can grow anything. What you should grow is a wholly different question. And not only driven by economics, but by water. Like I wouldn't argue, even if the government gave me the money to grow rice and wheat here, our water is worth more than the food. We should be a net importer of water as a country. People don't think about this, but your food has an embedded water footprint. People have an embedded water footprint, a certain consumption per human, right? So does food. And you don't want your government using its very limited water or desal, which is generally burning natural gas, right, to create water. If they're using that to make wheat, you'd rather source wheat from somewhere in the world with adequate water supply, lower labor costs, massive production. It can be ground, stored, and siloed, so you can have strategic food reserves both in the country, in neighboring countries. You can have an entire supply chain that protects your supply, but that isn't using your precious water for food. And that was when I was part of the National Committee on the Adoption of Ag-Tech for Food Security, very long name. But post-COVID, there was a national committee about advising and supporting the government.
This is on the UAE level?
It's the UAE's government supporting the policy response to how to think about food post-COVID. And this is exactly the advice we gave. Of course, it would have served my business interest to say, yes, build it all in a high-tech or mid-tech greenhouse. But that is not what I recommend, right? I think it has to do with the value of the good. Like I typically believe, and I could, anything perishable within 14 days that is water intensive and where quality is discernible to the consumer, because consumers eat with their eyes before their mouths and their bellies.
Like a strawberry or
a tomato, capsicum, cucumber, strawberry, aubergine, lettuce, microgreens, herbs, mushrooms, and any variety. All of these things can and should be produced in controlled environment ag, either locally or regionally. Because I'd say like Jordan or Oman is also very short food miles. It's close. And you can take advantage. For example, Oman has mountains with certain climate. You can take advantage of the, minimizing both the cost and the environmental impact of farming, leveraging that. But anything within that profile will typically be strictly dominant producing locally, meaning game theory, your cost quality curve will be dominant. And that's where you see us building a great business, right? Profitable, successful, accessing, of course, seeking to premiumize, like position the product as premium because it is, right? It's an absolutely perfect product. But we always try to be at a discount to the air freighted imports and at a premium to the local, seasonal, or regional lower quality product. At a discount
from the imported.
Well, it depends on the product. Sometimes the cost of manufacturing it can be expensive. So, for example, we could grow avocados, but the problem is they store too well. They can be shipped and stored in gas as they come across the ocean in a container. When they arrive, you can't compete with them, right? The price is too low. So your point of should they be cheaper? No, they can't be. It depends on the product. But if it's air freighted, like in the belly of an airplane, you're flying a sack of tomato water.
Yeah.
Generally, the cost of freight is so substantial, you should be able to manufacture or farm it at a lower price than is the import, right? But I want to highlight that actually consumers have this mentality. Well, you didn't ship it here. It should be cheaper. But they don't realize to farm in the level of farming methods that we do, no poisons, technology, both protecting it, climate systems, technology, engineers, maintenance, all project development, CapEx, the cost to capital on the CapEx, it is not cheap, right? Fundamentally, this is food infrastructure. You're raising capital, deploying that capital over 12 to 18 months to build the system. Then there's pre-production burn and working capital. So you're burning while laborers are working and people are doing things till the crop is now harvestable. So now you're
so what is 14, that, like a 2-year
14 to 18 or 14 to 20 months from shovel in the ground to money, to revenue, right? Yeah. All that while you got to pay a cost of capital. So the CapEx has a cost of capital against it, your weighted average cost of capital in debt and equity. And then now you've got to recover that capital in the price of every unit produced for the next 30 years because the asset will last 30 to 40 years. Now it works, but I want to highlight or maybe to people listening, the model of that is quite complex. We are more like Aqua Power building a desal facility than we are like a traditional farm. We're not just putting a seed in the ground, burying it, pouring water, and waiting 3 months at all, right? You got to recover these years of, and prior to the build was the R&D, design, engineering, piloting, seeds, sourcing. It is a deeply complex business. And I've said this to you, I think once before, but it's been a humbling thing to be at Pure Harvest. We're 6 companies in one. We're a tech company, buy, build, or partner in tech. You're a manufacturing company, just-in-time inventory management, because you have a perishable good that's highly regulated, right, for food safety reasons and you got to manage an extremely global supply chain, fertilizers and raw material inputs and seed inputs with output that then perishes from the moment you harvest it. So really rigorous operating environment. Your engineering construction company, you take the bare earth to the built environment. We're EMAR, taking dirt, power permits and approvals and a constellation of contractors that you're managing and contracts and capital and drawdowns. You're managing these complex projects as you build and construct them. You then operate and maintain them, and that includes farming, the actual agronomical management, but also the maintenance and engineering of keeping all the systems up and running that are quite specialized, right? And then you're a FMCG company. You deal with retailers and online, offline, Instagram and marketing, multi-channel marketing, building a consumer brand. And last but not least, you deal with the actual regulators and government intervention in the sector. Food, anywhere in the world, is a protected sector. So you're sort of a lobbyist. And these 6 disciplines all have to participate and work well together to do this. One of the things I got wrong about Pure Harvest is appreciating the minimum efficient scale. MES is a concept that
minimum efficient scale.
Minimum efficient scale. In every industry, there is a minimum efficient scale, which is the minimum scale to where you've captured most of the gains of economies of scale. And let me use e-commerce as an example. In e-commerce, you have to form a company license. You have to build some team to manage the business. You got to procure some inventories. And there's some minimum basket needed for your specific vertical market for people to even shop there. You can't sell one good.
Yeah.
Or it has to be a very special good, right? Yeah. And so you need some marketplace of goods for your vertical.
Yeah.
You then need the working capital, inventories, warehouse management, systems. You need a website, responsive. Now you've gotten to some level of investment that lets you even enter the game with a reasonable product. Do you see what I mean?
Yeah.
And that, whatever that is, it's meaningful. Now in our industry, the minimum efficient scale is very high. Why do you note that we have very few competitors? To come to this game, you need $50 to $100 million, and you need the patience to wait 3 years of losses as you build your first farms, run pilots, learn the climate, engineer, source technology, and you'll have to, I think, 3 to 5 years of losses. That's why there's nobody here, because the minimum efficient scale of the industry is very, very high. Now, the benefit is once you've broken in...
So the barriers to entry are very high.
Very, very high.
Yeah.
And higher than I thought. I would have said, if you had asked me, I did my little barriers to entry 4-5 forces model for somebody 7 years ago, I would have said moderate. You need some capital, you need whatever, you need to build a pilot, you need to learn. Now I realize it's much higher than I thought. And really, those who have tried to enter the space have struggled, right? Farmhouse entered the market and fell out. Madar Farms entered the market, fell out. Red Sea Farms we acquired. Al Dahra Baiva we acquired, right? There have been not a lot of successes, right? It's very, very challenging. Now, on the bright side, I think that Pure Harvest has done that work. We built that powerful brand. We have the capabilities and know-how. We're multi-crop, multi-country. 550 people in the company now that do nothing but this every single day, obsessing over how do we make it better and how do we grow. And the final comment on what you said about capital efficiency, we've launched business lines that are increasingly capital efficient. We didn't talk about technology. People have asked me for years, why don't you sell the tech? If I gave it away, somebody wouldn't be able to build this. I mean, as I just mentioned, tech's only one pillar of the 6. But what we can do is commercialize technologies or solutions for others where we've built tech that really adds unique value for us with our insight and our management. And we will be doing that. For example, market intelligence tools, an AI-powered yield forecasting model. We've developed robotic solutions that are very low cost that improve our ability to scout in our greenhouses, for example. So we will eventually commercialize technologies. And these 3 pillars, value-added products, sales, marketing, and distribution, trading, right, the Pure Harvest selections, and technology and services augment the core business of securing capital and building infrastructure, right? And I think the combination of these will make it a really unique and special company.
Speaking of valuation, right? The type of company that you've built, doesn't it make it hard to value? It's kind of like, I did some consulting once for a big conglomerate, right? And there's something called like the conglomerate discount. So when you have multiple businesses, right? And obviously they have different economics and even different industries, right? How do you put a value on like the big thing?
The big difference
here
is...
So for you, you're a tech business, you're farming, you are, as you said, building, you're consulting. So how do you value this?
This would be the opposite. The conglomerate discounts occur when there are disparate business lines that have no economies of scale or scope among them.
Okay.
Right? So in fact, there's diseconomies because the distraction of management among them often leads to suboptimal performance.
Okay.
That's where that comes from. This is the opposite. One leadership integrated in all, where the knowledge and insights gained in one feeds the others, or the intangible asset of the brand built in the core enables the other.
Yeah, but
so powerful synergy among the business lines creates value and creates differentiation versus anyone who tries to just be a tomato. Someone comes to the market to just be a tomato producer. Let's use us as for an example. An already powerful, established incumbency on the shelf, trust with the consumers, multi-crop. We also might have a very significant shelf share. Somebody better offer at a bare minimum. They need better price or better quality or both to beat us. Very hard to do when we're already at scale.
Yeah,
but then you also have the ability, the leverage over the retailer that you supply them multiple things and tons of services and good. So you're really going to take my business and just give him tomatoes and then all of the good that I provide for you? Whereas there's a balance and power in that relationship, right? So by launching and increasing your scale, it actually reduces the essentially monopsonistic powers that the retailer has, for example. So I want to highlight the synergy among the different businesses actually creates value. Now, to your point on valuing it, it does, because there's no real comps. The only comps that exist are, for example, Mucci, who does...
It creates a challenge.
Well, a challenge...
as you said, because you don't have comparables.
Yeah, that's why I would say where the challenge is that people have to think and do homework.
Yeah.
We have attributes of agribusiness, FMCG, and industrial technology.
And an FMCG business is valued differently than if you start selling your technology as a SaaS product, for example, to other farmers or greenhouses. And so it's like, yes, there are synergies, and yes, it's a single leadership, but they're different businesses in a way. Right?
I think in a way, anytime you don't have clean, perfect, simple comps, it's hard, right? Because you have the analyst or whoever is doing the analysis to value the company has to really do their homework.
Yeah.
They have to, whether it's some of the parts, whether it's really, they have to look at the business model and its attributes, its margin structure, its returns on capital, its capital intensity, how that compares. And they have to really think. Now, in the end, there are methods to do this. But to your point, yes, it requires analytical rigor. It requires somebody who has confidence and belief in their understanding of valuation to be able to do so. There's going to be no simple look at the three neighbors, average the multiple. It's going to be tough.
Yeah.
Now, what we've done that work for them. Like, it's interesting the amount of work. We have a reputation that our data rooms are extremely well prepared, partly because I used to have their job. So I feel responsible to give them the information they need to make a good decision, just as I would if I were in their seat. But we've done that work to break down who are the food comps in the region, who are the ag comps in the region, who are the FMCG comps, and who are the industrial technology comps, and who are the CEA, controlled environment ag comps around the world, to help investors to zero in on these are the attributes of these business models and why we think this is the right multiple range.
Yeah.
We provide that and actually serve it up to them.
Interesting.
So that's an interesting, as the company, I'm trying to help educate the investor universe on how to think about us.
Yeah. So comps is comparable. So other companies doing similar things. So, okay. So you're raising, you're out there now looking for $100 million.
Yes.
Right? You've raised nearly 300 million already, which is significant. So where do you go to get that money, right? I mean, I would still say, I think we have really deep pools of capital here. And I would imagine, actually, from what I've seen doing VC is that I think you have like some of the sovereign wealth funds that are, that have mandates to invest in venture capital. So there's all these fund of funds, but they're not big fund of funds. They're still relatively small in comparison, I think, to the size of the economy here.
Exactly.
Right? So, and then family offices, they're not necessarily big fans of venture capital. And you said that maybe they don't like the blind pool concept. They like probably to make investments on their own.
Yes.
But then, I had a meeting with BlackRock recently, and I think their smallest ticket is like 750 million or something like that. So they can only invest in infrastructure projects in this part of the world because their ticket size is huge. And I would imagine Mubadala is probably in that range as well, and PIF and so on. So in theory, it should be easier for you to raise money because you're not VC. I mean, you're not a typical venture-backed business.
We're very much growth stage private equity now, right? So what people would call crossover.
Yeah.
We hope the last ever private raise before we're of scale to go public.
Yeah.
The challenge,
why isn't it raining money on you?
I would agree.
You have a great narrative. You have a great business. It's food security, or I don't know how you classify it, but
so a couple of things. One, if you think about it, 100 million raise, any round needs a lead investor. Mm-hmm. That lead is at a minimum 25% of the round, usually 30 to 50% of the round. Then you syndicate to the round.
Can you take more than 100? By the way?
If the terms were, and then we have we have a whole pipeline of over 50 projects that we could draw down. Right. So again, we're constantly developing over 3 years out a pipeline of where would we go next. We've had discussions in markets like Maldives. Yeah. Maldives imports all of their fruits and vegetables. Right. They would love to have job creation, localization, powerful narrative in the hospitality. You can imagine, right? Brunei has reached out to us. We have a lot of markets. So we have a pipeline of projects, but we draw down a few, raise capital, build them, right? One day, when and if we're a public company, we would line up the projects, tap the market, sell some stock, right? Secure the capital, secure the project, and build. But for now, we have to do this, line up projects, say, hold on, I'll be right back, run to the capital markets, get the capital, and come back and try and meet the promises we made to deliver the projects, which is stressful. But why is it challenging and why is it hard? First of all, when I mentioned the lead, $25 to $50 million check for a lead investor, right? How many funds can write a $50 million check in the region?
Not VC funds.
No, but any fund. Again,
Mubadala can easily do that. I'm sorry, I keep thinking
but you're literally naming the two, right? There's Mubadala, PIF, which invests in ag via SALIC, Saudi Agricultural Livestock
Qatar, there's
QIA, who just lost $400 million in Infarm.
Okay.
There's Oman, Bahrain's Mumtalakat. How active have any of these funds been in direct investments in any company in the region? Not many. So you get what I mean. Yeah. Small list. And then you have the private equity funds. Gulf Capital, raising capital now, doesn't have an active fund to deploy. Abraj gone. Shua gone. They're struggling. I had some challenges, as you're well aware, quite public.
They're in your company, right?
No. They supported us in a debt capital raise. Yeah, and even we refinanced them, took them out. They were debt. Okay. Right. So private equity it's hard, right, to name. So that's the challenge. Now let's go to the ones that do exist. Folks like Mubadala and PIF and others, there's also a uniqueness in challenges about their mandate investing in agribusiness in their home market.
So they want to diversify and invest abroad.
They want to invest abroad, but also not crowd out local farmers, right?
What does that mean?
So local farms that are actually participating in the market, they back a player who competes with them.
So there's I think there's around 20,000 farmers or so.
Yeah, and maybe 4,000 commercial farmers.
Okay.
But so imagine Mubadala picks one to invest in and the others don't. That becomes very unpopular, right? Do you get what I mean?
Yeah.
So now, admittedly, other pieces of the government are doing that, right? ADQ, for example, is investing directly in companies competing with all the other ones. But not all pieces of the government are willing to do that or have that mandate, right? And that's also creates challenges. If these state-owned players...
They can invest in you to subsidize, let's say, technology for these 4,000 commercial farmers.
That would be a viable...
There you go, if it works.
Yeah, that's you. Thank you. No, but it creates a very complex...
Yeah.
You have these state or parastatal actors who have direct or indirect investments in a given sector.
Yeah.
And if they back specific players and wipe out the other ones, that has consequences, right? We talked at the very beginning about the ecosystem, capital formation. Imagine a world where, and I'll use ADQ is looking at our sector, has announced a few projects in partnership with Silal, which is owned by ADQ. And if those projects succeed and not only crowd out local farmers, but affect us, how popular will that be to international investors saying, we'll invest in a company, and then the state will say, what a fantastic idea, let's build one too. And then after the company's taken the risks, built the company and succeeded in the market, then they go back with their unlimited capital, a competitor. And if that company suffers, that's going to be a difficult narrative in the capital markets, right? About, we Pure Harvest has been a powerful advocate of invest in this region. We believe in it. You've seen us publicly and in media that it's a great place to live, international capital markets access, wonderful place as a proving ground for your solutions, et cetera, right? But when you build a company that's successful, the government might build a competing one. That's a tough narrative, right? And that could affect your exit. That could affect your valuation at exit. So I think that you ask about access to capital. Once you get to that level, it becomes a complex marketplace, right? Where most of the capital are investors who have a mandate to write a 25 to 50 million or more check in ag or FMCG even, if you want it, depending if it's defined as consumer or ag, it's hybrid of both. Asset intensive in the region who also has parastatal competitors, right? ADQ, Salal, and or in Salik having discussions via NADEC in Saudi Arabia. It creates a very complex narrative, right? And that's what I think creates challenges to where we don't, I'll be honest, we've talked to many investors, even notable private equity firms who have said, fantastic thesis, fantastic management team, top decile performance and profitability, but GCC, ag-tech, asset-intensive, parastatal competitors. And
your option today is to obviously get money from outside of the region, but also build outside of the region.
Exactly. And we've raised over 80% of our capital outside the region, right, to date, because of these dynamics.
That's the irony, by the way.
I know, right?
That's the irony.
I have to say, we're doing our part to draw attention to this place from the capital market. But isn't that interesting?
Yeah.
And I'll be honest, I didn't expect that early on. Yep. I've made the joke that if I knew what I knew today, I would have put my Stanford baseball cap on and went and raised for one day in Silicon Valley as a Silicon Valley CEA climate tech company and then built here. Because it would have been easier if I said I'm a US Delaware C Corp, invest in me, but I happen to be building in emerging markets. But instead, being the other way, a homegrown UAE company, it limits how many people have a GCC mandate in their pool globally, right? Massively. And I didn't realize that, of course, at the time, 7 years ago. But I want to caution, I'm being very transparent about the challenges we face because your viewership is about, collaborating on the ecosystem and et cetera. But I want to highlight we are getting there, right? We have significant interest, but it's been a lot harder, right, than I thought. People have asked me that or even thought it's been easy. They ask, how easy must it be that food security is such an interesting and supported
and
topic?
You had COP28 and you had like all of that.
And we were in the middle of it. But the challenge is that we've had support. Look at the Abu Dhabi Investment Office. They've supported our sector and others. There has been activity. But there hasn't been what people thought. Like there's been some massive infusion from Mubadala or PIF or somebody, right?
Yet.
Yet. We hope. So if you're listening, Khaldun, we're interested.
Yeah.
But I would say there's been the dynamic of the country prides itself on being an open economy. So we continue to have the borders wide open to any competitor who wants to sell their goods here. And that's a challenge when you have high technology, high capex, significant investment in capability. You have to, as I mentioned, that whole line to get to that fully amortized cost of production. Somewhere in the world, there's a tomato being produced cheaper at any given moment based on seasons and whatever, and it will find its way here, right?
Yeah.
And because there's no trade barriers. Now, Saudi has taken a different approach. Saudi's actually, a year ago, they put up a 15% import tariff, and there's discussion they may rise. So they are trying to actually protect their domestic market to drive domestic production. They've developed the Saudi Agricultural Development Fund, which is a very long-term, low-cost project finance to support agribusiness. Very attractive investment environment, right? That not elsewhere in the region is there as much being done because, for example, Kuwait has the Industrial Bank of Kuwait provides agribusiness loans that are low cost, but no market protection, right? But it's something to debate. I'm not somebody who's actively for tariffs, right? I think they can have risks, but they can be used strategically. Let me use an example, Norway. Norway, in the summer, erects tariffs to protect its domestic players because in the summer, somewhere in Serbia, there's a cheaper tomato trucking over there, right? Or anywhere in the region. But in the winter, the tariffs fall away and they let anyone sell anywhere. But then the domestic players invest in technology to produce in the winters in Norway. But if they didn't have that protection, those players would all be gone.
Yeah.
Because in the summer, the prices are so low and somewhere everyone wants the wealthy Norwegian market.
Yeah.
They flood the market with product. So Norway is just the inverse of us, right? And so that would be an interesting policy consideration. If the government wanted to support that incredible domestic food production and all the benefits that come with it, GDP, economic diversification, yada, 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 these protections would be worth considering. But the final comment on that is I do understand what they're trying to do. They want to control food prices. They want to ensure that availability is there for all demographics, not just ultra premium and expensive. And so I understand the approach they've taken. But for someone like us, and it led to what you said, it leads to looking at growth abroad as well.
Yeah.
But producing in Morocco and Tunisia, producing in Jordan, right? These are markets where you can have a lower cost of production and be competitive and not have to face all of those challenges.
Yeah. I had Chris Rogers in the previous episode, and we were talking about you offline, by the way, and he was saying, Sky is extremely resilient. Like he was telling me that you've been fighting it out for a long time. So it does. You make it look easy, but it's Well, tell Chris thank you. Yeah, it's been humbling. I would say this business has been harder to build than the prior two summed. And I think it's unique also to the sector. I have a great respect for farmers. It is a 365-day-a-year business, right? That plant is alive and it needs care. It's got to be harvested. When the storm struck earlier this year, we had to harvest. You can't just leave it on the vine and say, we'll get back to it later, right? Everything, it's a very operationally demanding business. I had a great business education in banking and private equity. I then had an MBA at Stanford, but I think I've completed my business education at Pure Harvest because it is, we mentioned that complexity, capital markets, innovation and challenges, project finance, governments and trade policy and economic challenges, infrastructure, supply chains, enterprise resource planning systems, technology, everything is in this company, right? You were telling me off the record, how many types of financing have you done?
13
different types.
Equity, multiple rounds of equity in different securities. No, but 13 total capital raises to date.
Okay, 13.
But in different types, it would probably be 5 or 6.
Yeah.
And most companies might do 4 to 6 capital raises in their life, right?
Yeah.
We can do for a year, right?
Yeah.
And
So
this year,
you're constantly fundraising.
and in some form, debt, equity, grants, project finance for a given project, et cetera. Yes, it's a. Ask my finance team. My CFO Andrew, he jokes that he's like, yeah, we run both an agribusiness and a private equity investment firm. Sometimes it feels like it. And not to mention, we do acquisitions, right? We've acquired 2 businesses already, and we're in the process of a third. And we're looking to acquire a platform acquisition in Morocco. We've been very public about it because we're very committed to the market there, serving Europe.
Yeah.
And as part of that, we were evaluating 11 targets. We narrowed it down to 6, now down to 4. And you can imagine how much work goes into evaluating 11 acquisition targets.
Yeah, so in addition to running 6 business models.
Exactly right.
Before I wrap, I want to ask you, how did you learn to become the leader that you are today? I mean, no one knows how to run a business at that scale, fundraise, buy companies, 550 employees, $300 million in funds raised. I mean, this is a significant responsibility, going back to you have their money in your pocket. So how did you, on a personal level, learn to become the leader that you are?
I would say I'm still learning, right? I think most good managers and leaders have some form of imposter syndrome, and I certainly have it, where I constantly feel I'm not doing enough, I'm letting someone down, I'm forgetting something, I'm overseeing, I have oversights. But I would say I had a unique background in that I started from the other side. I started in private equity, sitting first as an observer on boards, and then eventually as a board member representing the capital interests of my companies, and then became a business builder. And what I would say is I've tried to be, and I try to keep the humility to be, a constant student, where I watched first when I was in private equity, talk about having an inferiority complex. You'd be on the board of some manager who had run 3 companies. I'll use one of the CEOs. His name was Sunny Sanyal. Sunny had run healthcare for Microsoft, reporting, its CEO, Harvard MBA, brilliant businessman, and a really capable CEO who later went on to run Varian, a $7 billion medtech company. And sitting on his board, of course, I'm the board member representing my investment firm. I was 31 years old or something. But I quickly realized who was teacher and who was student, right? But I also took the opportunity to try to learn, to watch how he led, the cadence of his management. I've even asked him when we traveled together questions about how he led the team and how he thought about it, or how did he, because he had a unique ability, and I think still does. I used to call him Yoda. He had this calmness no matter what was going on, and this ability to get to the 3 things that matter. And he would give me lessons about how you could spend unlimited time studying everything. You have to get to the ability to say what really matters and then focus only on that, or your time and attention can be eaten. And that's an example. So studying first as an observer and then board member, studying the managers themselves and trying to remember the learnings. And then also now studying my peers, my colleagues. Like, I learn a lot from my colleagues and what the experiences they've had in the companies they've been part of. My master agronomist, Jan Prins, has forgotten more about a tomato than I will ever learn, right? But learning from trying to really dig in and ask piercing questions about how does this work? What do I need to know to do my job well about what you're doing, right? With not trying to acquire mastery, but just a profound understanding. And so I think that's it. I try to read. I don't make enough time for it. It's hard. But at the very least, read book summaries and key insights. When you hear about a great book that comes out with some disruptive insight, I try to get a hold of the insight at least. And then, ask questions. So I think it's that being a constant student. The final thing I would say, though, there's this great publication that was written. Harvard did a study on, it's called the CEO's Calendar, I believe, or the Leader's Calendar. And it was a study of, and it was led by Michael Porter, but they studied 15,000 CEOs over some period of time, and they engaged with their executive assistants and said log every 15 minutes for a year what this person does, right? And what it was about was, how do CEOs spend their time? What are the activities that they do? And then also, how do they find balance? And what about how they spend their time predicts performance? And I encourage every CEO of a startup or aspiring one to read this, because what's interesting about it, it was a really great place that summarized all of the activities that a CEO is doing. And you find it illuminating use it almost as a checklist of saying, am I thinking of all the things I need to be thinking about, right? Am I thinking about governance and making time for strategy, making time for my health? Am I for my people and one-on-ones, for my what they call rank and file, but kind of direct line employees? Am I making space for that in my life and in my calendar? And then try to deliberately organize yourself towards what they predict or they show as the successful calendar. They say that something like a 64.5-hour work week is normal for a successful CEO. I aspire to 64 and a half. I think I'm more like 70 to 90, but I'm trying to get myself to 64 and a half. But just the aspiration for it, working toward it. And literally every quarter, you can ask, Bahar is my executive assistant, ask her, we talk about it every quarter. How are we doing toward the CEO's calendar? Because we're constantly trying to check, am I making space for my personal life? Am I making space for the board and for every stakeholder group? And I find that is a way that helps to mold you increasingly toward a never-present goal. It's always an evolving and far-reaching goal, but to really deliberately try to manage your time and your efforts towards what that mix of activities is that makes a successful leader.
Yeah. I guess, there's the saying that the task will expand. The more time you give it, the more the task will expand, right? So if you don't put those limits on how much time you want to spend on something, you can end up spending
unlimited time. I struggle with that. Boundaries and really setting boundaries. And it's an effort I've had over the last few years, but otherwise it can be all encompassing. You're putting in more time toward the goal, but you're not realizing it's taking away from some other piece, your health, your family. And when those things go wrong, you lose a lot of time, right? So it's actually, you're not really gaining, right? And that's something I'm trying to be increasingly conscious of. But I would say it's a moving target. As you said, I'm still growing into being the leader I need to be. I think focus is an area. I want to do too many things, and I have this inherent optimism that things will be faster, better, easier than I think. And I try to temper that. It's probably a good thing in the end that I'm constantly aiming for everything and believe in my people that we can deliver that. But on the other hand, you risk burning out an organization or burning out yourself. Learning my organization's speed and aligning my goals to that speed is an important piece of my leadership acumen that I'm still working on. So I have areas that I still need to improve.
This has been an amazing conversation. Loved everything you said, pretty much. I think it's been a mini masterclass about farming and controlled agriculture, CAE.
Controlled environment agriculture,
CEA. Okay. Great advice to founders. Great advice on how you should treat your investors and the relationship between founders and investors. I think it's been a fantastic discussion, and I'm going to hold you. I do want to bring you back. I think there's still a lot that I'd still like to discuss with you. This has been great.
Happy to do so. I'm really thank you for having me. Very supportive of you and what you're doing here and educating and engaging with the ecosystem. And thank you, Loulou, for having me back. I'm happy to come back again and talk about different issues.
I think actually we should revisit I'm just thinking we should revisit the one we did 4 years ago and see.
Comment on it?
Yeah, and see how far the discussion has.
And how gray my hair has become.
Yeah.
We'd be happy to do so.
I think we've both grown quite a bit since then.
Well, thank you for having me.
Yeah, thanks. Thank you so much for tuning into this episode of Conversations with Loulou with Sky Kurtz. I hope you found it insightful. As usual, don't forget to visit conversationswithloulou.com to check out all the other episodes. Make sure you are subscribed wherever you are listening to this podcast or wherever you are watching it. This way you get informed every time a new episode drops. And please take a few minutes to leave us a rating and a review. I read all of the reviews, so really makes me happy, and it would really help in getting the show discovered. You're seeing this on December 30, 2024. I wish you all great holidays and a great end of the year, and see you all in 2025.